Welcome to the Capital Exchange. I'm Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, more people have access to or are currently using target date funds because they're a popular investment option inside of employer plans such as a 401k or a 403b. So let's dig into target date funds into more detail.
Yeah, target date funds, Steve, are blended investments that adjust their asset mix from more aggressive to more conservative as you move closer to that target date or retirement date. And they're popular because they're easy to use and generally they come at a reasonable cost.
Yes, Travis, but I think it is important to point out that not all target date funds are created equal. You have different providers or different families that will have different costs or different glide paths as you approach that retirement date or target date, as you mentioned. So depending on the management, funds may also be more aggressive than others, and we're seeing that more and more today because of the current interest rate environment we're in. So managers are having to constantly reach for return anymore, aren't they?
Yeah, that's right, Steve. And additionally, there's been some rule changes that will actually allow target date funds to invest in private equity markets. And we know from previous videos that private equity markets have been growing while the public equity markets have been shrinking. So this potentially gives some investors access to an asset class they haven't had access to in the past. But it will likely increase the cost on these target date funds, making due diligence moving forward even more important.
Yeah, that's right, Travis. Target date funds can be a great accumulation vehicle, as we know, to save for retirement. There are other considerations for you if you have outside assets, though, that you need to be aware of. And these target date funds may not actually be the best fit for every person if they have this situation with assets outside of their 401k.
Yeah, you're right, Steve. I mean, you should look at all of your investments as a whole and consider placing different types of assets in the most tax-efficient accounts based on your tax situation. A common example may be if you're in the highest tax bracket, to place your fixed income in a qualified account, because then the interest paid on those bonds isn't taxed at the highest income tax rate.
Yeah, Travis, and that's a great point. Now back to target date funds. So fast forward, once the target on the target date fund has been reached, the target funds may not be the best, those target date funds may not be the best option for a distribution phase, though, of your life, is it?
Yeah, that's right, Steve. The distribution phase of your life comes with a different set of needs than the accumulation phase. Now your portfolio may need to generate income in addition to growth and capital appreciation. So we like to use, our bucket strategy, which helps us design a portfolio that provides an element of safety, an element of income, and an element of growth for clients. And generally, a target date fund can't accomplish all those goals simultaneously.
That's right, Travis. This has been great. I look forward to it next week.
I look forward to it as well. Thank you for watching this week's Exchange.
To make sure you don't miss out on future discussions, please follow us on social media.
Make sure to like and share our videos, and we'll see you next week.